that we're not going to get into. But for the most part, if I borrow 100 grand out of my house and I use it to do whatever, live on, pay off debt, I don't get a tax bill because it's a loan. When you actually it works not on your house as well. If you spend money on your credit card, take money out, you don't get taxed on it either. Loans aren't taxable. And I'm not going to dive into the small nuances of chance that it could be taxable. If you want to do that, we can do that on a one-off. But the fact is, when you turn 62, Dan just said, and so did everybody that knows what they're doing in this room, Tane, everybody I know in this room, Scott already has his. He has no problem talking about it. We're jealous. On our 62nd birthday, that's our birthday presents to each other. I'm going to Tane and say, hey, let's work up my paperwork, buddy. I'm ready. I can't wait to get my reverse mortgage. I got a $1.3 million house that's got a bunch of trapped equity in it that's no good to me. Let's talk about that. What do you mean it's no good to me? I love this visual aid. Used it for years. Still use it. Always will. But this, Scott's money I'm betting with tomorrow, that's real. This is not, believe it or not. This is equity. If I take a picture of my free and clear home and go down to HEB, and I'd hope we don't have those, so you can tell I'm a Texan on the camera. Go down to HEB, I cannot walk out with groceries. I can take a picture of my house and say, I would like to buy some groceries today with my equity. They're not letting me leave. I have to convert this into money. And the only way I can convert it into this, there's two ways for everybody in this room. Two. Only two. One is take a loan. The other is sell my house. Now something's strange. Every time I've sold a house, somebody else wanted to move in. It's really weird. If you've experienced that, you can probably raise your hand. It's not a good way to get equity because you got to go find somewhere else to go. This stuff, when you take a loan, it comes with a payment. I'm coming up here in a couple weeks being married to my bride for 26 years. She is one brave, amazing woman. I don't want to leave her a payment. I'm not saying that I couldn't get life insurance and do other things, which I have. They can guard that. I'm not getting into semantics, but the fact is, if I take it at 45 years old alone, I have a forced payment due every month, the rest of my life till I pay it off, and she does too. And believe it or not, when I bought my house, I paid a forced payment. It just happened to be one. I wrote a check, and it was a forced payment. If I didn't make that forced payment, I had a bunch of little ones to make. Agreed? That's how it works. That's how equity works. Now, when you understand how this is going to play in your life, the reason I'm going through this so much detail is this isn't complicated, is it? Simple. We know these things. But we don't understand equity. We don't understand how powerful it is, how it can be used, and how we have it all wrong. And the stuff we believe to be true about it is really a myth or a lie. See, when we retire and the job goes away, and it's time to buy groceries, we're likely going to get it out of our Social Security, our pension, our IRAs, and most retirees, we just talked about it, 98% of them aren't even considering spending the equity. Dr. Wade Fowle just showed us the last resort most of the time, 60 to 80% of the time in his research, would be the wrong way to go. And like you said, you could refinance the reverse, so if you bring that into the equation, most of the time, if not all the time, somebody should at least get a reverse mortgage so they could take this and turn it into this whenever they needed to. And when you have this stuff, you can get groceries and you can survive, and that means you don't have to spend your assets. Now let's quit talking out of both sides of our mouth. People come all the time and want to talk out of both sides of their mouth. They want to be like, oh, I would never do a reverse mortgage. I would never do one. My grandma had one. They took her equity. And when she died, I hardly got any money out of that house. I will never do one of those. Anybody ever heard something like that? I've heard stuff like that, and it impacted me. I'm an emotional person. I'm a very passionate person. I have strong empathy. The way I was raised by a single mama. So I don't know, she's a crier, so she passed it on to me, and it's always the way I've been. But my whole life, I've had a lot of empathy for people. And I resonate with widows. I love working with them because I just see my little mama. But I can tell you, when I'm dealing with those people And they are so passionate about their equity in their house because they put so much money in. They had to make sacrifices. They say things like, do you know what it cost us to pay that off or pay that down? Do you know the sacrifices we made? I do. I was 19 years old when I bought my first house. And I had it paid off by the time I was 26. Because I worked hard and made lots of sacrifices. When my friends were out partying and playing, I was raising kids, had a beautiful wife, and paying house payments and doing everything I could to get debt free. I made tons of sacrifices. And I can tell you, I understood the passion behind that's a special bucket of money. But there's false to that. It's not all true. And when I understood money for the first time, it was when a good friend of me and Dan's, a colleague of me and Dan's, I would love him to still be my really good friend to be honest, but his name is Harlan Acula. It's the very example of what Scott said earlier. He said to me, Shain, if everything you thought about mortgages was wrong, when would you want me to tell you? And my life changed that day. Totally changed. Because I had it wrong. He told me the truth, how this loan worked and how equity works. And when you understand it today, I hope you'll take away this with you from this. This next couple minutes is worth coming, I think, because this is what got me. See, when you have money in that bucket, it makes money. 4 to 7% conservative advisors in here. Do you think I can earn 4 to 7% over time on that bucket of money? That's very conservative, right? I mean, even if I delay taking Social Security, it's likely going to earn 8% from full retirement age to 70. I know it'll get 8%, but there's lots of accounts. I mean, what you can get on a CD today? 5.5%. There's lots of money you can make. 4 to 7%. The reason why is because rates are relative. Back when rates were lower or higher, Wade, I think, said we had 16% rates in 1982. Well, what you could borrow was higher too. They're relative. But understanding this bucket, most of it's going to be taxable. Outside of a Roth IRA, cash value life insurance, some muni bonds, mostly everything there's taxable. And most retirees don't have a Roth IRA, or if they do, they don't have much. Because it's our generation coming up that used the Roth a whole lot more than they did. Because they were told a lot of misinformation. And they didn't trust the Roth as much, and they definitely didn't put it in much. And it wasn't around their entire life either. But understanding when we spend money out of that bucket, we're likely going to pay the IRS a chunk. You brought up this state. Let's just talk about it for a minute. Your guys' taxes are, when I saw somebody tell me, I think they told me the state tax were like 11% or something like that.
Even if you're poor, it's 9.3%.
9.3 for poor. I don't know what California poor means. He's still making 150 grand a year probably. But the point is, if I have to take money out, this $100, I'm not getting $100. Between state and federal, I might get 70 of it. The point is, when I take money to buy groceries to live, I got to pay theirs. And understand, I also lose the ability to earn money on the money. We call that opportunity cost. So let's not talk about sides of our mouth like we talked about. Grandma, they took her equity. No, they didn't. She spent it. We took anything. Here's how it really worked. In fact, I've used this exact example to people that have said that to me. I'll say, well, did mom or did grandma have an IRA? Well, yeah. Well, I bet you she saved her money in that IRA her whole life. And when she retired, she had the gall to spend it. She bought groceries and she traveled. And when she died, you hardly got any money out of that IRA, so you should never do one of those. Those sound awful. Who in the right mind would do that? But we laugh because we understand how they work. They just don't understand a reverse mortgage, so they say things like that. They don't understand it just like I didn't, just like maybe you didn't. And they say things they don't understand. They're not trying to give bad advice. They just honestly believe what they're saying. So when I spend money out of my house, it's relative. Now, I can't get a 4% rate right now, but you're probably looking at the 6 to 7% range for money right now. And am I wrong there, loan officers? Somewhere in that gap. So when you're spending money between 6 and 7% out of this house, it's tax-free. It's not taxed because it's a loan. So if I need $1,000 if I need $100 from Scott, I got this free. See? It's tax-free. When I need $100 out of my house, if I take it from this pocket, we'll call it assets, I'm not getting $100. If I take it from this pocket, called equity, I am. Now, I don't care where you want to move the ball around and understand you have the same amount of money until IRS gets their cut. If I got $1 million in each bucket, if I die the next day, if I have $1 million in assets and $1 million in equity, if I die the next day, how much do my kids get? $2 million. If I spend $100 of it, they get $100 less. No matter which bucket I spend it from, they're going to get less. So I tell people all the time, well, do you want to leave money to your kids? They'll say yes. So how important on a scale of 1 to 10? Well, some people are 10. Well, I'm like, then you should probably die. I say it just like that. I mean, if you die, they'll get more. So try to die today. Now, that's terrible, and they know I'm kidding, kind of. But the thing is, that's the only way, because they're going to spend money. And unless they have enough money, they can live off the interest or the interest. I mean, they can live off it to where, I call that a cow. You know, you can live off the milk and the cheese of the cow. But if you need a little bit of beef, it ain't going to survive very long. You might sneak a little out, but you ain't going to get much beef. The point is, if you start spending money out of the assets, it goes down. If you start spending money out of the equity, it comes down. We all agree, right? This isn't crazy. This isn't rocket science. But we're not taught this. When I went to school in finance, I never got taught this. And the studying for my 6 and 63 and 7 was tough, I can tell you. I didn't get taught any of these things. None of it. And I can tell you, understanding how money works, Dan brought up 1099, 1098 deductions and all that stuff, how to do that. And I love what you talked about there. I'm going to try to give you a practical example of what that looks like. You talked about Harold Levinsky, and you talked about Wade, you talked about my favorite, Dr. Barry Sachs. In fact, last time me and you spoke together, we talked with Dr. Barry Sachs. He came into town here as well. Is anybody here for Dr. Barry Sachs? Well, Dr. Sachs is probably the smartest individual I've ever met. No offense, Wade. You're right there. Really close. He really is. And, you know, this guy has a PhD in physics from MIT. Got a little bored with that, so had to go to this little law school called Harvard and get a tax law degree. And the guy wrote an article, if you'd like to get it, we can get it in your hands, in the Journal of Taxation called Recovering a Lost Deduction. And in this article, he talks to financial professionals like yourselves on how to get money out of your IRAs, things like that, tax-free by using a reverse mortgage and stacking your interest or delaying paying payments and paying them strategic, like Dan talked about, so that you could take that money out and offset income. See, when you take money out of this pocket, the assets, and we move it to this pocket, we're likely going to have to pay Uncle Sam along the way. We all agree? So if I have a house payment, now listen close. If you're a retiree and you are still making a house payment, listen really close. That's probably the stupidest thing you could do. Because you're taking money out of this pocket, let's call it $1,000. Everybody with me? $1,000 house payment. Let's put ourselves in a 25% tax bracket. Is that fair? State and federal. So if I take $1,000 out, I'm going to have to pay $250 to Uncle Sam, so I only got $750 left just for an easy round number. Well, I can't pay my house payment. If my payment's $1,000, I got to take, $1,250 or whatever, a little more than that. You can follow my math though. We got to take $1,250 or so, pay Uncle Sam to move the money over here just to make a $1,000 house payment. Now, if I take $1,250 out and I die the next day, my kids are getting less. Yes, they're getting a little bit more equity, but Uncle Sam won in that transaction. But what if I said, I'm not going to take the $1,000 out. I'm just going to let the $1,000 payment be paid by the house. I'm going to let the house pay the payment. I'm going to let the equity. So yes, I spent the same $1,000, but my kids got more the next day if I die because Uncle Sam wasn't part of that just immediate transaction. But the whole point is, I'm spending money either way. We all agree. But as I pay payments, I might get issued a form I can use. I'm going to get issued the form. I just might not be able to use it. We call it a 1098. Anybody ever heard of a term called itemization? Anybody have a clue what a married couple over the age of 65, what the itemization is like this year? What the itemization limit is? It's almost $30,000. 29,000 and change now. Okay, so almost 30,000 bucks. Let's just call it 29,000 for an easy number. Now that means they have to have. I love Dan. He said everything I want to say just so eloquently. He talked about how he's going to stack his interest, how he's going to do this personally, how he's going to do his charitable contributions in that year. He's going to take advantage because there's 4 key items you can deduct on your itemization: the interest on your house, charitable contributions, state taxes up to $10,000, and you might want to get that hip replaced that year. Medical. So if you can stack up a bunch of stuff in that year and itemize, you might be able to take a lot of deductions. We agree? So let's say that I had a mortgage for an easy number of $1,000. Likely, I don't have enough interest to itemize, right? But what if I had a mortgage that let me pay voluntary payments? That's the key word, voluntary or optional. What if I decided I'm going to let my interest grow so I can pay it later? We talked about later, Tane. Well, let's take later is a year. Well, a year from now at $1,000, let's say it's all interest, just for an easy number. That'd be $12,000. Is $12,000 enough to itemize? No, it's not. Not unless I have a lot of other stuff, charitable contributions, medical, state taxes. We all agree? Well, after 2 years, I got $24,000 and change. Let's round it to 25 because it compounded. So I got $25,000. Is $25,000 enough to itemize? We're getting close, especially with those other items. But let's say I wait a third year. Let's say I've got, we'll round it. Let's say 40,000. Everybody with me? I got 40,000 of interest. Is 40,000 enough to itemize? It is. Now that's the year I want to do all the stuff Dan talked about. Maybe I got another 15 or 20,000 I can add on top of it. Maybe get to 50 or 60. Well, imagine you had a loan that was insured by the federal government to never be shut down, altered, or changed. They couldn't take away my access to those funds, provided I just live in the house as my primary residence, keep my property taxes paid, which, by the way, you got to pay even if the house is paid for. Try not paying your property taxes and see how long you own your home. And you got to keep your insurance paid, and you have to keep your HOAs paid. All things that you would have to pay if the house was paid for. We agree? It's not a trick. It's life. If you never really own anything. Theirs, they own a lot. But when you understand how this loan works, it's going to start sounding too good to be true. All the time, I give classes on this to the public. Many of you have seen me. Cynthia, we've done some. I can look at faces where we've met with public. And I tell people, I'm going to move along the way. You're going to go from this loan sounds awful to this sounds too good to be true. Let me know when we get there. I've had people be like, we're there. This sounds too good to be true. And I answer it the same every time. This loan is not too good to be true. It's simply too good to be free. FHA is going to charge you a 2% insurance premium to make sure that that line of credit is available for you, so when Dan decides to do that strategic payment, just like I will, we can move our 50 grand over to our house, pay down our debt, and we can have our 50 grand back tax-free. They won't shut it down or take it away, and it'll grow. Like Dan talked about earlier, like Wade talked about. I can have it back, plus it's got compounding interest growing on that 50,000. Does that sound too good to be true? It's not. It's just too good to be free. Now, the loan might be expensive to set up, but it's really inexpensive when you look at the benefits. And when you understand this loan, it's got to be in your portfolio, in a planning portfolio, because it's going to give you a lot better chance to make it. And here's the truth. It's almost 3 to 1. People are more scared of dying before they run out of money than they are dying. I sit down with people all the time and I'll say, how old did mom and dad live to be? Well, dad was 78, mom lived to be 92. What's your plan? Are you going to be able to make it to 92? Well, I hope I die before then. Anybody ever heard something like that? Yes. You might even think that. To some degree, I don't know if I want to live to be 92 either, but should the Lord tarry, I'll take my chances. The point is, When they say to me, I hope I die before I run out of money, or I hope I die before then, I always make them repeat it. You hope you what? Your plan for retirement then is hoping to die. Let's try to make a better plan together. And when people say things like that, they don't really mean them, but at the same time, they're scared. They're like, I know what I have in that bucket. Wade talked about it earlier, about getting back down the hill. It's scary. It's hard. It's when most of the accidents happen. It's very difficult to navigate back down. Many financial professionals in this room, you might be really good at helping people stack and make money, but it's a lot different skill set to help people get back down the mountain. Financial advising, much tougher. Because when people start spending money, you know why a lot of financial advisors do not want a house payment in retirement with their clients? Because they don't want to have to manage the cash flow needed out of the bucket they managed to feed a $3,000 or $4,000 or $5,000 house payment that comes every month. So when it's paid off, they're kind of like, I'm not on the hook for that $5,000 that comes every month. So many of them prescribe getting the house paid off and leave the house on the sidelines as a legacy play. I tell my clients all the time, would you like to pass more money to your kids or less money? They generally say more. Not all do, by the way, but most. Some people have like a little sticker on their RV, say, I'm spending the inheritance, you know. But most do. A good man leaves an inheritance to his children's children. I want to leave an inheritance to my children's children. That would be called grandchildren. I want to do that. But that has a lot more to me to do than money. I think inheritance and a legacy that my grandfather left me is much more than the money he left. I'd rather have a day with him than the money, to be honest. But I'll tell you, when you understand legacy and what people's goals are to leave, they get so passionate about it with all the sacrifices they've made. Some people are like, no matter what, I'm leaving the kids the house. Anybody know people like that? And they're just so passionate about it. Remember, they put so much money into it. You have to understand how we feel here and here. And if you are going to work, you loan officers that work in the reverse mortgage space, you have to become a psychologist. You have to understand people and listen to them and be empathetic to know they have a right to feel that way. They have made sacrifices for them, for their kids, for their grandchildren. They love them. They have a plan for them. They want good things for them. And you need to understand, they just don't know that's not the way. I'll say, do you want to leave them more? Let me show you a way. Your way will leave them less. Let me show you some research by a guy named Dr. Wade Pfau. And I'll often put up Dr. Wade Pfau's picture, and I'll say, see, he even looks smart. Look at that guy. True story, Wade. I say it all the time. Fact is, when you understand money, when you understand equity, and you understand what I'm talking about today, you're going to understand that if you want to take care of your clients and you want to help them leave a larger legacy, they need to know when to spend money and which order to spend it from, which bucket to take it from and when, sequence of return, knowing how to use a coordinated strategy. They also need to know how to avoid paying taxes or eliminate taxes. So if they want to pass more money and pay less in taxes, and they want to have more money themselves in retirement, they should get a reverse mortgage and get it as early as they can. Let me say that again. If they want to pass more to their heirs, have more of themselves in retirement, and pay less in taxes, they should get a reverse mortgage and get it as early as they can. Their options will increase. We need to change this product's name from the reverse mortgage, which is a totally negative connotation, to the option mortgage. It increases your options. It gives you more chances of success, not less. Now, does it work 100% of the time? No, because nobody has a crystal ball. In 1982, when rates were 16%, the reverse still wouldn't have been bad, right, Wade? If I'd had it open and I had a $100 balance on my mortgage, it wouldn't have been a bad thing. Yes, I would have paid fees to open it up, but that's just an insurance policy. Anybody here have car insurance? Please raise your hand. Keep it up if you want to get in a wreck. Nobody wants to get in a wreck, but we have car insurance because we hope we don't get in a wreck, but just in case we do, we're going to use it. I may never use my reverse mortgage. You may never use it. But it's great to be insured in case you do, especially with your largest asset. Why would we store all of our cash, or a lot of our cash, or most of our cash, in one geographical location, one place in the United States of America, subject to risk, that's not liquid? Who in their right mind would do that on purpose? You understand? That's what we do. Now, again, if you don't want one of those forced payments, I tell people all the time, I think having a house paid for and the peace of mind that comes with it has about a 12% rate of return to me. Peace of mind can be a great thing. But what if you had a mortgage that had no required payment, allowed you to take the money as you need it, can't be shut down, altered, or changed, as long as we do those things we talked about? That changes the equation. You can get access to that money and still have safety. See, now, I ask this question all the time to professionals. Then why wouldn't we recommend this to every one of our clients? What's the boogeyman? You can't lose your home, like we talked about. Dan said it's never happened. The only way you're going to lose your home is the same ways that you would if the house was paid for. Don't pay your property taxes. You don't pay your insurance, your house burns down, you don't get it back, right? You don't pay your HOAs. In many states, they can foreclose and take your house. Those things happen without a mortgage. Now, I'm not going to beat on Dave Ramsey anymore, but if I wanted to, I could show you a video right now of 93-year-old Virginia he has on one of his programs, who's losing her house to one of those terrible reverse mortgages that he tells people not to do 100% of the time. Why? Because she's behind on her property taxes. Now, when people listen to that story, they resonate with Virginia like, oh, that's terrible. But she went for 13 years without making a house payment. Now, what would it have been like if she had to make a house payment? She would have lost the house much sooner than that day. See, when somebody is not making, I mean, I've seen Dan use that scenario, and I watched him do a little illustration off of it that was great. But when you understand that that's the kind of misinformation that's out there, that's the stuff we have to overcome. That has nothing to do with the reverse mortgage being bad. Now, I'm not going to go through these basics again very in depth because you already went through them today. You got to be 62 or older. There are products that start at age 55. But the reason why none of us covered that today because we're focusing on FHA's product. There are products that start at age 55. If you want to learn more about those, talk to your C2 loan officer, your certified loan officer, and they will tell you more about it. But you got to live in the house. One of the loan officers in this room, I won't mention my name, he reached out to me this last week and said, hey, I'm working on a deal, and they got 2 houses. Which one do we do it on? I said, the one they live in. Well, they live in both. I said, well, where's their ID? What's on their photo ID? What's on their driver's license? Where's their mail going? That's likely going to be that primary residence. Where's the house? So you can do it on the vacation home. Wade, you said you can't do it on the vacation home? You can. It does become the house you're going to live in more. So I have people, anybody ever heard of McCall, Idaho? I have people that have really nice $2 million cabins and stuff up in McCall, Idaho, and they might have a $500,000 house in Boise area. And I'll say, well, are you considering living maybe 6 months and a day in the McCall house? We could probably do it there, but your ID and your mail and all that stuff needs to sniff and smell like your house. And so you can see the common sense behind it. They don't put ankle bracelets on it and monitor you and watch you with cameras, but it's the house you live in. It's your primary residence. Now, you keep the title to your home. Basic credit and income qualifications. I don't care if you have a credit score. I've done a lot of these loans where people didn't even have a credit score. So it doesn't matter there. But there are some things that credit can have an impact on and income can have an impact on. Dan touched on this earlier. So did Wade. They call that a LISA, a lifetime expectancy set-aside account. We may have to set up an account to pay taxes and insurance, and it may keep them from qualifying. There is ways to not qualify. I've had people who said, I'll wait to make it the last resort, like Wade talked about earlier. I'll wait and do it later. And then all of a sudden, the spouse dies, and they're down to one Social Security, and they just don't qualify. They don't have enough income, they can't pass the residual test, there's all different reasons. Well, imagine losing the love of your life and 30 to 40% of your income in a single heartbeat. I see that happen every day. And it's heartbreaking. And people think, I'll get it then. And sometimes they can't. So it's kind of like this. I just talked about car insurance. If you don't have it, please get it. If you go out here and hit somebody and it's like I think you talked about calling Geico. If you call Geico right after the wreck, no 15% savings on car insurance. I think they're going to say no car insurance. You need it before you're in the wreck. Okay? So, the last living borrower needs to live in the home, and if somebody goes into a assisted living or a nursing home, somebody goes to assisted living, the other spouse stays living in the house, we're fine. If they both go to assisted living, as long as they're not going to come back to the house, there's no, it's not a temporary thing, it's time to sell the house. The letter of the law, it works like this. You're going to have 6 months in which to sell that house. And you can ask for extensions that can get you out to a year. But you need to refinance or sell in that period of time. I have seen loans go beyond that period of time, but you really have to work with the servicer and HUD to get that done. But without any extra exceptions, you can get 6 months and you can do 2 extensions to get you out to a year, no problem. Okay, so during that time, you definitely want to reach back out to your C2 professional, get somebody to help you. Melissa, my assistant, we help people with loans we didn't even do all the time navigate that process. Dan said it this way. When somebody dies, somebody's probably going to freak out. Is that what you said? It's very true. Because the heirs never got clued in on how it worked. They have negative connotation. They think they need to back everything up to the house and get it out tomorrow because the bank's coming tomorrow to take it. It's just not the case. We need to educate them. Please, financial professionals, get the kids involved. Especially if the parents will let you, get the kids involved. Educate them about all the finances, including the reverse mortgage, because the chance of you keeping the assets under management will go up if you get the kids. We agree? They're likely to walk out. Your money's likely walking over to their financial advisor the second you have a death if you're not involved anyway. So get involved. Make sure they're educated. Get in your C2 professional to make sure you're helping them. Now, you can do this up to 4 units. You can do it on manufactured homes. So imagine that you wanted to buy a 4-plex and live in 1 unit and rent out the other 3. You could do that. Now let's make up a crazy example. Let's say there's a worldwide pandemic. We'll call it COVID for a weird name. And all of a sudden, the government says we're not going to make people pay rent. They're okay if they don't. They don't even have to make mortgage payments on certain things, and that's okay. But all of a sudden, that's where your income comes from. That might have an impact on you. In fact, what if you have a mortgage payment you have to make of your own and you don't have the income coming in? I know that's crazy and that would never happen. But let's just pretend. Wouldn't it be nice to have a mortgage you don't have a payment on? At least you don't have to send a payment in. Understanding this loan gives you more options, not less. You can take money in a lump sum, you can take it in a line of credit, you can take money like Wade talked about in 10-year payments. So a 10-year payment means it's going to pay you the rest of your life if you read the letter of the law till your 150th birthday. In fact, the last borrower, the youngest borrower's 150th birthday. I have never met somebody who lived to be 150. So they've done it, obviously, to go out past where we can live. Now, you could take a term payment. Maybe you got terminal cancer, and you say, I want to just give money with a warm hand instead of a cold hand, like Dan said, and I want to see my kids enjoy the money, and I'm going to get the most money I can out of my house over the next 5 years. You could do that too. You could also do a line of credit, draw money as you need, or get a lump sum, take a bunch of cash out. Has anybody ever heard of a cash out refi? Maybe refi and take a bunch of cash out, pay off some debt, things like that. And there are rules around that. Purchases are generally done as a lump sum because we're going to take all the money on the purchase. Somebody buys a $400,000 house. I know that doesn't exist here. I give classes everywhere. Yes?
There was another slide that said the home value maximum was what?
Oh, that's an old, that needs to be updated. It's early. It's $1,049,875. Yeah. Yeah, I saw that too. That's why I clicked right past it. I appreciate that. We try to do slides. You try to update everything, and then every now and then you're like, well, that one got missed on that one.
Paying attention.
Thank you. Yeah, it's 1,049,875, I believe now. 1,149,875. Sorry. 825. So 1,149,825. Yeah, I can just tell you, hey, I didn't false advertise. I told you, as far if I had that at about 6th grade, it's about where that stopped. Now, I like to use this example a lot. Harlan showed me this too. I use it all the time because it's so true. I watched him present this once, and he actually had the rotary phone with him. You know, we understand how rotary phones work, how a regular phone works. That phone, we plug it against the wall, it's going to work great. My grandparents had a black one in their house, much like that one. And in fact, it had like one of those cords on it that went like 80 feet long. It was the wireless, you know. My brother would come by and like choke him. But the thing was forever long, and it was awesome. It was an indestructible phone. I think you could like throw it through the wall. But it made great phone calls. And it was cheap. You know, the day I took this picture, the day I put that on there, you could get that phone for $18 on Amazon. Now, I don't know why anybody would want it. Maybe for a presentation. But this picture of that phone that day was $1,000. The cell phone. How many people in here have one of these? You probably get one every 3 or 4 years and spend another $1,000. Why? Because it's valuable, it's full of options. It's not just a phone, is it? It's our Facebook, our Instagram, our GPS. I mean, and most people don't even own a camera or video recorder anymore. This is a lot of things. This is our computers. It's our lives. But we pay for it because it's worth it. It's full of options. This loan is more expensive than a regular loan, but it's worth it. It's full of options. A regular mortgage, just you can make phone calls with it. That's about as far as it goes. So understand, you get what you pay for in life. All right? As you can tell, you get paid what you pay for in life. I'm the only speaker here today that didn't get paid anything. So you can see, you get what you pay for in life. Don't blame me, blame Scott. I guess I got paid a little. $100. Now I want to show you how that line of credit works. That line of credit works like this. As you can see there, the orange line and the green line. The green line is a 4% appreciation rate on that house. And the orange line is a 6% cost on the money. As you see that money go up over time, so basically if you had a 6% rate and a 4% growth, eventually those lines would cross. You follow me there? If you're getting charged more on the money. Now right now, Wade and Dan both talked about this, how the loan used to be good and used to cross. Wade, you had a lot of examples like that before, didn't you? Lots of examples of where that line crossed. It doesn't cross as easy now, but it's still possible, isn't it, Wade? It's possible. If you live long enough, it could be possible where you're going to cross that line. Now, to me, you win. If I can spend more money out of the account than I put in, that's a good deal. If I can live in the house all that is my wife, and my wife can't, and I can spend every dollar from this pocket, leaving more money to my kids, you know what? I'm going to tell you a secret. My kids don't want my house. They want the money from my house. Your kids don't want your house. Every now and then I get, oh, my son wants a house. His name is Basement Billy. He wants the house because he's already in it. Isn't there a way to it's possible? If you live long enough, it could be possible where you're going to cross that line. Now, to me, you win. If I can spend more money out of the account than I put in, that's a good deal. If I can live in the house all that is my wife, and my wife can't, and I can spend every dollar from this pocket, leaving more money to my kids, you know what? I'm going to tell you a secret. My kids don't want my house. They want the money from my house. Your kids don't want your house. Every now and then I get, oh, my son wants a house. His name is Basement Billy. He wants the house because he's already in it. And when you throw away his Xbox, he might move out. Yes, he's 52. But the good news, in 10 years, he's reverse eligible. The fact is, less than 0.5% of kids want the house. 99.5% of the kids want the money from the house. Understand that. That's a fact. Ask your people, ask your clients. And when they say, oh, my kids want the house, I'll say, so they're going to move in the day you die? Oh, no. They're going to sell the house. There we go. Now, I had one lady sit with me. She was convinced. She goes, no, I want this house. It's going to stay in the family. There was 8 heirs. I said, well, then the house is worth about $1 million. I said, so even if the house is paid for, let's do the math. I mean, you're going to be able to afford an $800 and change $1,000 loan, $900,000 loan. Started doing the math with her, showing her what she's going to have to cover. She's like, no, I can't afford that. So well, you got to pay out all these other people. It's like the light bulb went on. You see, we don't think things through like that. If you got 2 kids and you want to leave them 50-50 even, if you got $1 million house, one of them's got to get a $500,000 loan to buy the other one out. Lauren, I'm going to pick on you. Well, your parents can leave you the house. That equation, do you want to go pick up a mortgage tomorrow for $500,000? No, thanks. I know my kids wouldn't. I got a 22 and a 24-year-old. I'm proud of them. My son just got married, got back from his honeymoon yesterday, and my daughter just got dropped off at medical school this last week. I'm a proud dad. And I'll tell you, neither one of them are wanting to come back to Texas, back to Texas, and live in my home. I told you he looked smart. Every time I give this class, I like to give credit where credit is due. All kidding and joking aside, Wade, thank you. Thank you for what you've done for our industry. His book says I make no money from reverse mortgages because he doesn't. This guy is not selling reverse mortgages. He's a researcher, and he has taken the time to change countless lives by showing the facts from a non-biased position. I'm going to tell you something. I am biased. I make money from reverse mortgages. In fact, I'm the National Reverse Mortgage Director with Scott Harms. I very much benefit from reverse mortgages. Tane, you benefit from reverse mortgages. Dan, you benefit from reverse mortgages to some degree. You're becoming less and less. You'll be neutral here in about a year, I think. At a point, you will. But the point is, here's a true neutral guy. I want to thank you because we need this research to show people you have it wrong, you believe a myth. It's time to learn the reverse truth. Thank you so much. Thanks for coming.
Thanks, Shane. Entertaining and informative as always. Great job.
Hey.
So we're getting close to the end here. Stay up here. If you'd come up, Tane, Wade, and Dan, we're going to have a little Q&A. Why don't you,
I wanted witnesses.
why don't you moderate the Q&A.
Yeah, you got it.
And then, stick tight. Don't set up the bar, so we'll let you go through the bar.
All right, so we'll let them set up that bar. I really want to open it up this time. So we did this class before. I've done this class before. And last time I did the class with Wade, the overwhelming feedback I got from people was, it was great, we had a good content, but we didn't have time to ask the questions that we had. And Wade was gracious enough to do a webinar with us later to go through some of it, but it's just not as impactful as a live moment. So, Tane Cabe again, his book is Double Your Retirement Dollars is in the back. He'll be signing them during the happy hour if you'd like one. Get to know him. His tool, his Heckam tool, I can call it that, right, is awesome. We have Wade's book back there. If you'd like this, he could sign a copy and give it to you as well. This is his 3rd edition, just got released. And then if you didn't get this already, you should be on all of the table. We have extra of these as well. This is Dan's new book, Navigating Reverse. I would suggest getting Dan's book called Understanding Reverse. And this, I'd read it first, read this second, if you haven't read it yet.
Just don't ask me to sign it.
Yeah.
I have tremors. I can't sign anything.
Yeah. So Dan's not signing. I'll sign it for him.
I'll scribble.
Yeah. All right. Thank you so much. Let's open up for questions.
Sorry. You mentioned that there are some specialty products that you can get at 55 that have the equity line provision. How do we get to those?
All right. The question was, there are products at age 55 that have the equity line provision. Anybody want to take that one?
Yeah, they're called proprietary reverse mortgage products. The fixed rate products generally don't have a line of credit associated with it, but the adjustable rate, there are some, but the growth rate is extremely low. The ones that I'm familiar with have a growth rate of 1.5% that grows over 7 years and can be drawn over 10 years. So it's not as secure as a Heckam in that it doesn't have the significant growth element. Also, the draw period is 10 years, so it actually caps the time in which it's actually usable.
So you start at 7 years earlier
Yeah, and there are a lot of motivations for doing it. I mean, that's life-changing when you talk about a $4 million property and wiping out a $1.5 million mortgage. That's life-changing. There are huge advantages in having a proprietary reverse mortgage. 75% of the proprietary reverse mortgages in America right now are in California. So this is definitely a hot market for proprietaries. Anybody else want to chime in on that?
It was great. I'll give my 2 cents on it. I'm not against a proprietary. Done them. But Dan said, for the right client, it can be life-changing, but it's not the same client. It's different. You're not getting it for the line of credit growth and using it for a lot of these tools because that line of credit can be shut down, altered, or changed. Anytime. Just like a HELOC. Go back to the HELOCs. Now, it's still a non-recourse loan, but let's say the market tanks and the $400 million house becomes worth $2 million. The bank can say, we're not going to let you have the access to those funds anymore. There's other things about it. Again, 7-year draw period, 10 years, so 10 years open. It only grows at a 1.5% interest rate. There's lots of things about those proprietaries. So I would suggest this. Sit down with an expert. Look at your options that make right for you. Nobody should be given the same advice. In other words, not everybody should be given the same advice.
Hey, let me add also, Shane, that the proprietary products do not have the same non-borrowing spouse provisions. So if you have a younger non-borrowing spouse, I really don't like the proprietaries in those cases because they don't have the protection. Only the HECM product has non-borrowing spouse protection.
And different states, different rules on those proprietaries as well. Take my home state of Texas. Everybody has to be over the age of 62, even for the proprietaries. So there's things to know. We could go down that rabbit trail for a lot. There's already a lot of information to be given. I would just say on a proprietary, if you have any questions on that, get with a professional and look at that scenario.
Is there a note or something in writing where by HUD where they can't freeze the line? Is there something?
Is there any provision by HUD where they can stop raising the line?
Yeah,
Yes.
I can address that as well. So in the security instrument, there are actually 2 security instruments, by the way, but in the security instrument, in almost every state, states require a maximum mortgage amount or maximum principal amount to be recorded in the deed. Okay? HUD steps in and says, if a state requires that figure, it will be 150% of the max claim amount on the day of origination, which is generally 150% of the appraised value. So let's say you have $1 million property, it will be recorded at 1.5 million. It'll actually be recorded twice.
Yep.
Okay? But the lender is not permitted to disperse funds beyond what's listed in the security instrument. Now, the reason why we allow the line of credit to continue to grow is because those loans would be assigned to HUD long before it ever gets to 1.5 million. Once it actually gets to 98% of the maximum claim amount, HUD's actually going to service those loans, and they play by different rules. They'll provide the money.
And Dan is bringing up 2 very important points here. One is the 2 security instruments, the 2 notes. Most escrow officers at regular escrow or title companies don't know that. That's why it's very important to use like Allegiant or Premier Reverse Closings. They're both listed on our Blue Door portal under Reference Preferred Vendors because they're experts at it. And in particular, Allegiant, their specialty is getting everything your processor needs to them the day of closing to get you paid the next day. But they also know how to get the deal closed with 2 security instruments. The other thing is as we move closer to a refi activity, when you go to look up